Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I'm going to talk about real quickly why stock options are so much less risky than stock. When you buy a stock, you are taking far more risk of losing money than if you buy a call option. And so I'm going to go over a couple stocks right now just to show you why that is. So here we have Netflix, and I'm going to go to the 1-year chart. Today is September 15, 2018, and in the past year you can see that Netflix has done pretty good. It's gone from $200 all the way up to right here. At one point it was up to about $420 a share, and then bammo, the bottom dropped out and it took a big hit. Okay, and let me shrink this down to 3 months so you can see exactly what happened, how much money Netflix lost. And this was all due to earnings that came out. The earnings were bad, subscriptions had dropped, and so it looks like back on middle of July it was at about the $415, maybe $420 level, and then it went all the way down to $320 a share, and it did that in the span of a month. Okay, so in 1 month it lost about $100 in share value. Okay, so if you would have bought the stock at that level, you would have, number one, you would have had to shell out $42,000, right? 100 times $420 a share is $42,000, so very expensive. And then your $42,000 would have turned into $32,000, right? Because at one point it dropped all the way down here. And yes, you could have held on and not sold and have it recover a little, but you'd still be down, right? It's still not back up to where it was, so you'd still be down $5,000. Okay, so let's look at what happens if you would have instead bought the call option. Okay, now let's say we would have bought an at the money call option 1 month out. Okay, so let's take a look at what would happen and how that works. Okay, and it looks like the 1 month calls right here, $360 call right there. The bid is $2,330. The ask is $2,380. So let's say you could get that at the money call for $2,350. But let's say you would have spent more. Let's say it would have cost more because the price is higher. Let's say you would have spent $2,500 for a $420 at the money call. Okay, so here's what would happen. Okay, you would have lost all $2,500 of your investment. And the reason why people say that call options are risky is because when you buy a call, you lose 100% of all your money that you bought the call for, which is true. But let me ask you a question here. Okay, would you rather lose 100% of $2,500, or would you rather lose 20% of $42,000? Okay, do the math here. Okay, so don't get fooled by the little mind tricks of, well, I'm losing 100% of $2,350. I would much rather lose $2,350 than lose $10,000, because that's how much money I would be down if I would have instead bought 100 shares of Netflix. I would be down $10,000 instead of being down $2,350. So it would have saved me $7,500, almost $8,000 that I would have not lost out of my account. And then yes, the stock's recovering, but I'd still be down $5,000, which is still more money than if I would have lost $2,350 on that call, or even $2,500. So there's your first example right there on why it is way better to buy a stock than it is to buy an option. You cut your losses drastically, so dramatically, that it would behoove you to spend some time to learn how call options work. Now let's move on to the next stock, and let's look at Facebook, right? Big, nice, big cap stock company everybody's heard of. And let's look at this chart, and let's go to the 1-year chart. And again, Facebook has been doing pretty well in the last year. Took a little drop, and then it went up, and then look at that, bammo kazammo, the bottom fell out. And let's go ahead and shrink it down to 3 months so that we can see just how much money that this stock dropped. So it looks like back at the end of June, looks like the last week of June, it was up to about $215 a share, not quite $220. and it went down from 215 all the way to where you see right here. Look at this. So from the end of June to now September, it's all the way down to $162 a share. So it's gone down from 215 to 162. So that's about what, $50? $50 drop in the stock value. So if you would have bought 100 shares of Facebook at that level, you would have had to spend $21,500, which would now only be worth $16,200. So you would have lost over almost $6,000. You would have lost over $5,000 had you would have bought 100 shares of the stock. Now, if instead you buy a call option, which is a contract to buy the stock, you're not actually owning the stock, you own the contract. Let's look at the at-the-monies, okay? So here we have the 1 month calls, and it looks like for the $160 call, the bid is $650 and the ask is $665. So let's say $660 you can get that call for. Okay, so first of all, if Facebook, let's say you would have had to spend $800 for an at-the-money call, you know, a few months ago. Okay, and let's close this out. And so in the span of June, July, end of June, end of July, no, actually that's the end of July. I was wrong. So from the end of July to where we're at now, so in about a month and a half, in about 6 weeks, you would have lost $5,000. Okay, now if you would have bought an at-the-money call like I just showed you, and let's say it would have cost more because it's higher, let's say you would have had to spend $800 or $900, you would be down $800 or $900. You would lose $800 to $900 on your monthly call, and because that monthly call would expire, and you would lose all 100% of your $800 or $900, right? But again, which is better, to lose $800 or $900 or to lose $5,000? Would you rather lose 100% of $800, or would you rather lose 25% of $21,000? Okay, so again, I don't know about you, but I think it's much better to lose $800 or $900 than it is to lose the $5,000 that you would have lost if you bought the stock instead of just buying a call option. So there you go, two good examples on why buying calls and puts are so much less risky than buying the stock. So again, it would behoove you to take the time, learn about these options, learn how to buy and sell stock, and also if the stock does go up, you make the same return as if you own the stock. You're basically making money on the movement on the stock as if you own the stock itself. So if you make, let's say, $500 on a $21,000 investment, then that's fine and dandy, right? You certainly wouldn't complain about that. But let's say you only spend $900 on a call and you make the same $500. What kind of return on your money is that? That is about a 60% return on your money. So the returns are higher, the risk is less, the losses are less. And this here concludes my video on why buying and selling stock is more risky and why buying and selling calls and options are so much less risky than buying the actual stock. So thank you for watching this, thank you for watching this video, and I hope to see you in the next one, and have a good day.